Legal Advocacy's Low-Income Taxpayer Clinic. And tonight we'll be talking about tax topics for immigrants. This is the third in our series of tax talks heading into this tax season. So I'm glad that you're joining us. My colleague, Soraya Finley, will be monitoring the chat. So if you have any questions, feel free to drop your question into the chat, and she will be happy to attempt to answer your question. Again, Arthur Bartlett, Low-Income Taxpayer Clinic. So let's dig in here. The North Carolina Low-Income Taxpayer Clinic provides low-income North Carolina taxpayers with free representation in federal and state tax controversies. Our attorneys are dedicated to helping taxpayers understand and manage their tax issues, regardless of language barriers. So if you speak as a primary language, a language other than English, we can assist you. We have staff who speak Spanish, and we have the ability to bring in interpreters that speak other languages so that we can help you with your tax needs. The cases we work collections issues. So if you have a balance due, you owe the IRS money, we help people get into installment agreements, submit offers in compromise, get them into currently not collectible status or hardship status. We deal with earned income tax credit questions. We deal with audits, appeals, liens, levies, tax court litigation. Really, our practice runs the full gambit of tax controversies, and we're here to help. So again, if you're low income and you have a live tax controversy, please reach out to us. There'll be some information at the end of the presentation about how to reach us and request assistance. But tonight we're going to be talking about tax topics for immigrants. We will cover residency and non-residency, ITINs and Social Security numbers, which tax return you should file, and credits, child tax credit and earned income tax credit. I'm also going to touch briefly on people who have an ITIN and get a Social Security number. I'll have a little bit to say about that at the end of the presentation. Residency versus non-residency. So U.S. immigration law refers to those not holding U.S. citizenship as aliens, as immigrants, non-immigrants, and undocumented aliens. This is what the U.S. tax code says about people who aren't citizens. The U.S. tax law only has two categories for aliens. That is a resident alien and a non-resident alien. The taxation of income is based on the residence of the taxpayer, the source of the income, or a combination. These components are the bedrock of the U.S. tax system. Residency determines who is subject to U.S. taxation. Source is where the income is generated. So foreign income has its source in any other realm, technically called a foreign state or a country. So if you have income in another country other than the U.S., then that is foreign income. Sovereign states always have the right to tax their own income. Diplomacy and tax treaties govern states' interactions with other states as to the treatment of taxes between states. And when I'm saying states here, I mean foreign countries and the United States. So technically in the code they're called states, but the taxation of income you might have here in the US or income you have in Canada or some other nation will be dictated to a large extent by treaty relations with other countries and the US tax code itself. And your residency status, whether you're a resident or a non-resident. So why residence matters. In the U.S., taxation of non-residents is very different from that of U.S. persons. That would be citizens and tax residents. U.S. citizens and tax residents are subject to tax on their worldwide income, no matter the source. So if you are a U.S. citizen or a U.S. tax resident and you have income from anywhere in the world, the U.S. is going to tax that income. Non-residents are only taxed on U.S. source income. So they're only taxed on income generated here in the United States. So why subject yourself to U.S. taxes? This gives you access to credits and the standard deduction that non-residents generally don't get. So there are benefits to being treated as a U.S. resident for tax purposes. Resident alien, a person who is a U.S. resident but isn't a U.S. citizen. Non-resident alien, this is a person who doesn't qualify as a U.S. resident or a U.S. citizen. There is no such thing as an illegal alien in the U.S. tax code. So the tax code just simply refers to resident aliens and non-resident aliens. It does not refer to illegal aliens. That terminology is not used in the U.S. tax code. Who is considered a resident alien? So here I want to give you a word of caution. The next part of the presentation, we're talking about some of the specific rules that determine whether or not you are a resident alien or a non-resident alien. The rules are fairly complicated when you start digging into them. So this presentation is not intended to teach you exactly everything you need to know about determining your residency here in the United States. It's simply intended to give you an idea of some of the issues you want to think about when you go and seek tax preparation help and you're considering what your status may be. This is informative. We're not giving you definitive guidance here. It's very complicated. So with that said, who's considered a resident alien? Green card test. Lawful permanent resident, likely has a social security number and must report worldwide income. So if you have a green card issued by the United States, you are a lawful permanent resident, you very likely have a social security number, and you must report your worldwide income when you're doing your U.S. tax return. That's one way you can be considered a resident alien. The other way is if you pass or meet the substantial presence test. This is a fairly complicated test. So it's based on a formula of days and years a person is physically in the United States and likely has or needs an ITIN. These people likely have or need an ITIN, right? If you meet the substantial presence test. Okay, so here we go. Substantial presence test. Stay with me. Okay. So it applies to aliens who are in the United States, are not permanent lawful residents, and are not exempt individuals. So you can see this is getting fairly complicated. An exempt individual includes foreign government-related persons with an A or G visa, teachers or trainees with J or Q visas, and F, J, M, or Q student visa holders. And wait, also professional athletes. So that's my favorite. That is my favorite exempt individual. Okay, substantial presence test. The taxpayer is physically present in the United States. The United States is defined as the 50 states, the District of Columbia, and U.S. territorial waters, not U.S. possessions, territories, or airspace. So, when I said the rule's complicated, it is complicated. Substantial presence. You must spend at least 31 days in the first tax year being filed, and you must have 183 formula days looking at the tax year immediately prior to the tax year of filing and 2 years preceding that tax year. Okay, so you have to count a bunch of days. You have to meet the 31-day portion of the test and the 183-day portion of the test to meet the substantial presence test. If you meet those tests or you're an exempt individual, then you are considered a resident alien. Now, there are, of course, exceptions to these rules, but this is generally the framework for determining whether or not you're a resident alien. Okay. Taxpayer may be exempt from the substantial presence test by statute or because a closer connection is maintained to another country. So, of course, I set out these rules, and now here's an exception to that test. So even if you meet the substantial presence test, you may not be considered a resident alien if you have a closer connection to another nation. So again, this is informative to get you thinking about some of the things that you have to consider as you're determining whether or not you need to prepare a tax return and which tax return you need to prepare. Okay, Counting the days. Whew. Okay. In the tax year, each day counts as one full day and must have at least 31 days in the tax year. Prior year, each day counts as 1/3 of a day. 2 years prior, each day counts as 1/6 of a day. So taxpayers with a 3-year formula count of 183 days are residents for the tax year, unless they can show they have a closer connection to another country or an exemption by treaty or statute. Okay, it's there. You can go back and look at it. Again, these are the tests. This chart here describes, it's sort of a decision tree, so you can see as you answer these questions and you work yourself through these tests, whether or not you are likely a resident or a non-resident alien. So I encourage you to come back to this chart and think about your own situation. Okay, of course, there are special rules. So there's a first-year rule, a non-resident alien spousal election that can be made, and of course, dual status aliens. And that happens in the first year of the that the alien is in the United States or the last year. These special rules are beyond the scope of this presentation. I would probably need another 15 minutes to cover these special rules. So we're going to move on, but know that these rules are out there and affect the analysis of whether or not you are a resident alien or a non-resident alien. Okay. I do want to touch upon a unique situation or situations involving a non-resident spouse. Okay. So a person is considered married no matter where in the world they were married. It does not matter if one spouse is living in another country. A U.S. citizen or resident alien who is married to a non-resident alien spouse who does not meet either the green card or the substantial presence test generally has 3 filing status options. The first, the taxpayer may choose to file as married filing separately. The second, the couple may choose to file as married filing jointly. And third, the taxpayer may qualify for head of household under the regular rules for a married person who is considered unmarried even while living with the non-resident alien spouse. Okay? So there are 3 choices available in this particular kind of situation. Each filing status, of course, brings with it benefits and disadvantages. The disadvantage of married filing separately is that you lose the ability to claim potentially greater deduction, and you lose the ability perhaps to claim credits that might otherwise be available to you. Okay. Married filing separately. The non-resident spouse, if required to file a return, would file a Form 1040-NR. Joint return. A married couple may elect to treat a non-resident alien spouse as a resident alien for tax purposes and file a joint return. If taxpayers make this choice, both spouses are treated for income tax purposes as residents for the entire tax year. Neither spouse can claim under any treaty not to be a U.S. resident. Both spouses are taxed on worldwide income. That's a theme here. The United States is one of the few countries in the world that taxes on worldwide income. If the non-resident alien spouse agrees to file a joint return, worldwide income of both spouses must be reported on the return. To make this election, taxpayers must provide a signed declaration attached to their joint return as detailed in IRS publication 519. And this is, again, very complicated. When can a citizen or resident alien who lives with a non-resident alien spouse file head of household? Okay. There is an exception that allows U.S. citizens and resident aliens who have a non-resident alien spouse to file as head of household. The following requirements must be met. The taxpayer is a U.S. citizen or resident alien for the entire year. The non-resident alien spouse chooses not to file a joint return. The taxpayer meets the other requirements for this filing status. And the spouse is not a qualifying person for head of household purposes. The taxpayer must have a qualifying person to be eligible for this filing status. So there are a number, again, of complicated rules that have to be met. You have to meet each of these requirements in order to do this. So, again, consult your professional tax preparer, and they can guide you through these complicated choices. Tax implications of resident status. Okay, so a resident will file a Form 1040 based on their worldwide income. So it's pretty straightforward. If you're a resident, you file just like all other U.S. taxpayers, and you're taxed on worldwide income just like U.S. citizens. Filing status, dependents, deductions, and credits follow the same rules as U.S. citizens. You may have dual status in the first year as a resident alien, and you may have dual status in the last year. I mentioned this earlier. So remember that sort of special rule that's out there. Okay, and there is a link here to provide you with even more information about your obligations in this situation. Okay, tax implications of a non-resident status. A non-resident alien files a Form 1040 NR and is taxed only on their U.S. source income. They're not taxed on worldwide income, just their U.S. source income. You don't get the standard deduction. Itemized deductions are limited to those related to the U.S. income, state and local income taxes, charitable contributions to U.S. nonprofit organizations, casualty and theft losses, miscellaneous itemized deductions, and ordinary and necessary expenses related to a trade or business. So you're not allowed the standard deduction like a resident alien or a U.S. citizen. You must itemize, and this is, generally speaking, the list of itemized deductions that you can claim. And the filing status is generally limited to single or married filing separately. This is for non-resident aliens. Okay, the Form 1040 NR. Again, this is the form that's used for non-resident aliens who are filing a tax return here in the United States. It looks very similar to the Form 1040. Again, non-resident aliens report income, subtract basically the same adjustments, standard itemized adjustments, they compute their tax, and then they claim credits and withholding. So the mechanics of the return are very similar, but what is taxed is different. U.S. source income, not worldwide income, and you don't get a standard deduction if you are a non-resident alien. You're limited to your itemized deductions. Okay, there is a special attachment that should be added to the return that indicates the days in the U.S. and any tax treaty claims, itemized deductions, again, which I just mentioned, and there is an exception to the ECI limitation for charitable giving and casualty losses. All right, taxation of non-residents, the good. So there are good things that come in this situation. They are that, one, you're not subject to taxation on any income but your U.S. source income. So no worldwide taxation like for resident aliens and citizens. You have the same tax rate as U.S. citizens on income effectively connected with a U.S. trade or business. And some types of income are not subject to tax. So certain horse and dog gambling winnings aren't taxed, personal bank interest, some dividend income, and under $3,000 of work for a foreigner for less than 90 days. So The bottom line is most immigrants will have no U.S. income tax obligation for the days before they become a U.S. resident. Okay. So there's some good stuff for non-resident aliens. Taxation of non-resident aliens, the bad. So of course, there's some bad stuff. You must itemize, and you cannot use the standard deduction and loan treaty exception for student/business apprentices from India. So there is one little exception to the being forced to itemize rule, but it's very limited. So that is a big one. You're forced into itemizing on your 1040 NR. Generally, you can't claim dependents. The exception is for U.S. nationals, residents of Canada, Mexico, South Korea, and students and business apprentices of India. So with every rule, there are exceptions, but these are generally the negative aspects of being a non-resident alien and having to file in the United States. So there's some ugly too, so not just bad, but ugly. And here I'm going to talk about the ugly. So you may be subject to a higher mandatory backup withholding, 30% tax rate on U.S. income not effectively connected with a U.S. trade or business, and you can only use a single or married filing separate tax tables. So that's the really, really bad or negative. Those are the really, really bad or negative consequences of being a non-resident alien. Okay, we move on. ITINs and Social Security numbers. So, what is an ITIN? It is an individual tax identification number. It is a processing number used by the Internal Revenue Service and is given to those not eligible for a Social Security number. These numbers are needed to file a tax return. So you either have to have an ITIN or a Social Security number to file a return. ITINs are not intended for use outside of the federal tax system. So they're not supposed to be used for employment, they are not supposed to be used for other purposes, they're used for purposes of the U.S. tax system. It helps individuals comply with U.S. tax laws and provides a means to effectively process and account for tax returns and payments. ITINs are issued regardless of immigration status. The ITIN is not an immigration enforcement tool. The application process for getting an ITIN is designed to facilitate tax payment. So the main goal here is to facilitate tax payment. And the fact that the IRS does not generally share applicants' private information with immigration enforcement agencies is a key to tax compliance. So the IRS is of single purpose. They want individuals to file tax returns and pay taxes on income that is U.S. source income or for citizens and residents, worldwide income. The whole purpose of the tax system is to encourage compliance and tax payment. And the U.S. And the Internal Revenue Service will not share information with enforcement agencies. Okay. The difference between the Social Security number and the ITIN. Taxpayer identification numbers are required on returns, documents, and statements. ITINs must be used by anyone who is not eligible for a Social Security number but has a tax filing requirement. Dependents and spouses need ITINs to be claimed on a return. And an ITIN does not authorize a person to work and should not be used on a W-2 form. That is really important. An ITIN, again, is just for purposes of filing a tax return. It does not authorize somebody to work, and it should not be used on a W-2 form. Okay, child tax credit. So now we're going to talk about a couple of important tax credits that are available here in the United States. What is the child tax credit? The child tax credit is a tax benefit to help families who are raising children. Children must be your dependent and under age 17 at the end of the year in order to qualify for the credit. You must also meet other eligibility rules. The child tax credit is a non-refundable tax credit, which means that it will reduce the tax you owe by the corresponding credit amount, but it will not result in a refund. If you get less than the full amount of the non-refundable child tax credit, you may be entitled to a refundable additional child tax credit. As a refundable credit, the additional child tax credit may result in a refund even if no tax is owed by you. Okay, if you don't qualify for the child tax credit or the additional child tax credit, you may qualify for the credit for other dependents, which is a non-refundable credit. A discussion of this credit is outside the scope of this presentation, but just be aware that even if you don't meet the requirements for child tax credit or additional child tax credit, you may meet the requirements for other dependents, the other dependents credit, and you should ask about that when you are getting your taxes prepared. Okay, are you a qualified taxpayer? The child tax credit is for, again, individuals who claim a child as a dependent so long as the child is a qualifying child. Only one taxpayer can claim the child tax credit, even if the qualifying child divides time between one or more households during the tax year. So you can have a situation where two taxpayers could claim a child for purposes of the child tax credit, but only one of them can claim the child. For the 2024 tax year, you can take full advantage of the expanded credit if your modified adjusted gross income is under $200,000 for single filers or under $400,000 for joint filers. If you and your spouse are filing jointly, you must have a Social Security number or individual taxpayer identification number issued on or before the due date of your return, including extensions. So don't forget this important. Note, if you apply for an ITIN on or before the due date of your return, including extensions, and the IRS issues you an ITIN as a result of the application, the IRS will consider your ITIN as issued on or before the due date of your return. Again, these are complicated rules. I can't emphasize enough, go to a qualified tax preparer when you're working through whether or not you're eligible for this credit, when you're determining your residency status. Please go find a qualified tax professional. These are very complicated rules. Okay, who's a qualifying child? So we can see here the individuals who are considered qualifying children. So son, daughter, stepchild, eligible foster child, brother or sister, stepbrother, stepsister, half-brother or half-sister, legally adopted child, or descendant of any of the above. So that would include grandchildren, nieces, etc. A qualifying child of a taxpayer, a child qualifies a taxpayer to claim the child tax credit if the child meets the following conditions. We talked about these before. Must be under age 18 at the end of under age 17 at the end of the year. Provide no more than half of their own financial support during the year. Have lived with you for more than half the year. Be properly claimed as your dependent on your tax return. Not file a joint return with their spouse. And have been a U.S. citizen, U.S. national, or U.S. resident alien. A bunch of rules. Okay. Earned income tax credits. This is the other credit I want to talk about. What is the earned income tax credit? It is a credit that helps low to moderate income workers and families get a tax credit. If a taxpayer qualifies, they can use the credit to reduce how much tax they owe or increase their refund amount. This tax credit has greatly reduced poverty of working families. Here we can see what the limitations are, some of the rules. I encourage you to come back to this if you have questions about whether you're eligible for the earned income tax credit. Rules for married couples. In 2024, to meet the EITC eligibility requirements, you can use one of the following statuses: married filing jointly, head of household, qualifying surviving spouse, single or married filing separately. You can claim the EITC if you were married, not filing a joint return, and you have a qualifying child who lived with you for more than half of 2024, if either of the following apply. You live separate and apart from your spouse for the last 6 months of 2024, or you are legally separated according to your state law under a written separation agreement or decree of separate maintenance, and you didn't live in the same household as your spouse at the end of 2024. Here are the qualifying child requirements. Again, a series of requirements that you must meet each of these in order to qualify for the earned income tax credit. Okay, EITC and ITINs. You are not eligible for the earned income tax credit if you or your spouse, if filing a joint return, have an individual taxpayer identification number instead of a valid social security. A child with an ITIN or an ETIN is not a qualifying child for earned income tax credit purposes. So these are important exceptions to, these are important requirements in order to qualify for this very beneficial tax credit. Okay, EITC without a qualifying child. Please know that even if you don't have a qualifying child, you may be eligible for an earned income tax credit. You need to work through the rules, and the credit is not as substantial as if you have as those situations where you have a qualifying child, but it is worth exploring whether or not you are entitled to the earned income tax credit, even if you don't have a qualifying child. Okay, and that is the end of my presentation. If you have questions for us, please visit us at www.charlottelegaladvocacy.org, and you can click on the tax clinic, and we'd be happy to take a request from you for assistance and get back to you, generally speaking, within 48 hours. Have a good night.